We're seeing it increasingly reported that the markets at these levels, the equity markets that is, we are overstretched and we are due some sort of a correction. But can you afford to be out of the markets for too long? If you don't want to be, what is the alternative strategy? Well, Trevor Neil joins us now from Beta Group. Trevor, the markets as they stand at the moment are in this unbelievable bull phase. I don't want to be out of it, but at the same time, you will say it's a very risky strategy.
Well, it is. I mean, there's no denying that the market is going up. In fact, it's becoming rather parabolic in shape. And although there are bullish fundamentals out there, tax cut, personal tax cut in the US, it's hard to really, well, it's quite surprising. The reaction has been so dramatically positive in this. The rate of climb has actually been scary. And fighting this powerful move has been very painful for people, although people have been expecting, and indeed more people are expecting, a pullback. The fact is that anybody who's seen the potential for a pullback up until now has been really slaughtered. It's just going up, and it's even going up faster. And so this bull run, even if we're not going down in the market, is definitely overdue for a correction. But this is a difficult thing to fight.
Indeed, this is the weekly S&P 500. So this is going back to 2014. Yeah. You can see, as you say, the parabolic rise. So what embodies this rise?
Well, it's been driven by a certain relatively narrow group of shares. They're not simply technology, but also media shares. So there's a group of shares which have who are responsible for a very large part of this rise. And if we look here now, this is Netflix. This has been the undisputed leader in the rise. It's up already 6% this year. It was up an incredible 21%, I believe, last year. So this has been a wonderful winner and a big driver in the market. There have been casualties for this. There's been good shares, old economy shares which have not followed at all, and in fact many of them are down on the year so far. So we've got a group, and I can tell you actually of the S&P 505 shares, there are 505 shares in the S&P 500, 117 have had double-digit returns, 232 have beaten the market with a total return of 6.4% or more. That's the return of the market itself. 408 have shown positive returns, one share is flat, and 35 shares are down 5% or more, including 5 that are down 10%. So we've got a group of shares which are really lagging, and we've got a relatively small group of shares which are doing all the driving, and some of them extreme, like this one here.
I said about this rise, you don't really want to be out of this market at the moment. So how do you hedge against that? What is the strategy?
Yes, it's very difficult. Of course it's very difficult because we are in a bull market. We've got a Goldilocks condition in the market, but we've got this parabolic shape to the market, which is extremely frightening. So what can we do in order to perhaps protect against a fall, but not participate in the market? So I want to go through a few of those strategies that viewers could consider. Now, the outright defensive and most aggressive defensive strategy is to sell short the S&P futures. And you could hedge your whole portfolio, neutralize your whole portfolio by doing that. Now, this is a very aggressive thing to do. Lots of people have been doing it to their cost because it's kept on going up, and the S&P short positions that they've got have cost them money. Same with options, put options in the S&P. We've seen how many people are buying these options as cover, but then they're going on to expire worthless and they've paid the premium. Another way is of shorting the market is through buying an ETF, a short S&P ETF, and there are several of those you can do. And if you were more aggressive, even you could buy the ultra shorts, if the S&P would go down 1 point, they would go up 2 points. That's leveraging the short side of it. But here you're exposed to the market just doing what it's doing, which is going up and up and up, and not you're not in it anymore. Now, another way of protecting yourself is to realize that the nature of the constituents of the drivers of the market will change if we have a setback. Now, as we've already said, we've got this extreme movement in Netflix and a small band of stocks, which are not all technology stocks, that have driven the market higher. Now, they are the ones where there's most likely to be profit taking and most savagely likely to be hit in a setback. And the beneficiaries of this are the good stocks, which have been basically not appreciated. So the sectors that have been poor and not appreciated, we can see from this relative rotation graph here, is utilities and real estate. They're on the bottom left there and heading southwest. So this means that on the performance and the momentum of the performance is extremely negative for these, and over on the right, top right there, are all the outperforming with positive momentum securities. So this has been a fairly static picture. And you can understand, of course, it's no surprise that those particular sectors are being hit with this new environment of rising interest rates. They're the ones that are going to be hit most by that. But on the other hand, they are really sold out. And so being as the profit taking is likely to come on the top right hand of this, the beneficiaries are likely to be the ones on the bottom left. So I think that if you want to be defensive and you want to maintain your portfolio, you could buy some cover by buying these sector ETFs in utilities and in real estate.
Okay, let's move on back to your defensive strategies, because you've got on the list theme rotation. How does that fit in?
Well, actually, the sectors, in a way, are not the best way of describing how this market has outperformed and overperformed. Here we've got a table of these sectors, and you can see that year to date in that middle column there compared to last year, the leader has been consumer discretionary, so not Apple, not Netflix, but consumer discretionary, healthcare, financials, then information technology, then energy, and going down, the worst performers, as no surprise, is real estate and utilities at the bottom of the chart. Now, I think that mix will change. So it isn't actually the technology sector that is totally responsible for the driver. It's actually not best described by sector rotation, it's best described by theme. Now, what has been driving the market, what I mean by theme is that you've got stocks which are high yielding stocks, you've got stocks which are growth stocks, you've got stocks which are value stocks and present good value, and you've got what has been driving the market, which is momentum stocks. So we can group together a group which includes the stocks which make up the leaders in this top group here, and these are stocks which have got a lot of momentum to them and is causing that parabolic shape. Now, momentum has been the driver. It isn't normally value and growth outperform momentum, but in the last 2 years, momentum has been the driver and it's taken over. So actually, momentum is the driver, and it's value that people don't like at the moment. Now, I would suspect that just as we get the sector rotation, we'll get rotation through these themes. And so my last suggestion for cover, without avoiding participating in the bull market, is to change the constituents away from this inflated and frothy area, which is the momentum stocks, and taking cover in the good stocks, and these are all good stocks, strong stocks that are in the growth area and value area and growth area, and I particularly like value because it is the most it's been most hurt. So I think that buying an ETF in value is a good cover. You are long of the market, you are long of the out of favour but good stocks and large cap stocks, and you're covering yourself against a relative decline in the momentum stocks.
Going back to your defensive strategies, I've got to talk about volatility, because we talk about volatility in terms of fear in the market, and there's the VIX index, which we've seen traded slightly higher in the last few days. Explain more about what's going on with volatility and how you use that as a defensive tool.
Yeah. Now, the VIX is often called the fear index, as you say. And what is extraordinary is that as the market has gone up, and even as it's gone parabolic, actually fear has gone down. It's gone down. Here's a long-term chart of the VIX.
This is the monthly candles, isn't it?
Monthly candlestick chart of the VIX. It's currently trading at 12.89%. It traded recently down as low as 9%, but the average over this period here on my graph is 20%. So we're way below average, and you can see that in the financial crisis it got up to 20. If we can look at the daily chart now, as you said, it has ticked up lately, and so this means that fear is sort of maybe coming in a little bit now. But remember, it's extremely low. The average is 20, and it is bizarre, really, that the confidence should increase when, to me, the danger is so high. But I think there's a little bit of reality coming in here now. So my final defensive strategy is actually to go long the VIX, perhaps the futures, March or even out to June futures. Because if we get a sell-off, a shakeout, a sudden drop, or even, frighten the market, and maybe people say it's all over, or it can go down, drop 20%, or something like that. When that sort of talk comes in, the way you will most clearly see it is an increase in the level of fear, and from below normal to potentially above normal under those conditions. And so this is something which could easily double in that event. And so maintain your portfolio, but hedge it with this component of fear, and take advantage of the fact that it is at this historically, bizarrely low level.
Okay, all right, Trevor, thanks indeed with some defensive strategies in this market that has at the moment still got that almost relentless move up, and as we've been hearing, it makes one feel fearful, but nonetheless you have to be part of it. But Trevor's strategy there to look at other ways to hedge your bets against that move. Subscribe to IG for educational content, company insight, financial analysis and expert commentary.